Hello, friends. Sunday, October 20th, 2024. The topic today is what's behind the Golds rally. Before that, I noticed last night on X and also this morning, people are complaining that engagement has diminished and many accounts have disappeared from X, and there is no interest in discourse any longer. This should be expected as we get closer to elections. But also the financial social media has taken successive hits in the last 10 years from crypto and then the pandemic when many financial analysts became pandemic analysts, and also from recently from AI, and, uh, and just people got tired of this noise, and they are not participating. And I have also noticed that. And also, I think that political tweets get more exposure, more impressions at the expense of regular people who don't want to get caught in this senseless elections debate. Uh, and this is, I think, what is happening. So let's talk about what's behind Gold's rally. Uh, we will start by saying that one problem with the macro analysis is the irrational escalation or escalation of commitment bias. And the macro analysis has missed the gold, the rallying gold, but also has failed to adjust to the current market environment especially after quantitative easing. Escalation of commitment is a human behavior pattern that has, in which individual or a group facing increasingly negative outcomes from a decision, action, or investment, nevertheless continue the behavior instead of altering course. So the actor maintains behaviors that are irrational but align with previous decisions and actions from Wikipedia. So we have all these macro accounts on Financial X. A few are good people and they provide a useful context, but most are repeating the same story over and over again, and they write pages of articles and multiple threads just to conclude that it's good to buy stocks. Come on, people. Let's be serious. I mean, this is a joke. All you need to buy stocks is a good moving average, like a 12-month moving average. You don't need macro analysis for that. This analysis is useful for other purposes, maybe high-level asset allocation, but not to buy stocks. Let's be serious. I mean, if you write a long thread to end with a statement, I conclude that we should be long stocks, so you are basically a noise generator, nothing else. You don't know what you are doing, basically. And I'm sorry to say that. So What's behind gold's rally? Well, a disclaimer, there is no investment advice in this video. So let's make sure everyone understands this. Before we answer the question, because we will answer the question here, what's behind gold's rally? The answer may surprise you. Gold is up 31.4% year to date, and the S&P 500 total return, the SPY ETF is up 24.2%, and 20 plus year bonds are down 2.2%. So gold is outperforming and has outperformed since January 2022 with a 47% total return versus 28.2% for SPY and minus 31% for 20 plus year bonds. So all this time, although yields were high, people preferred gold over stocks and, of course, bonds that pay interest, and gold pays no interest. And they had reasons for that. People, by people, I mean investors and traders. And they have their reasons. Geopolitical risk, systemic risk. They see the debt skyrocketing. In the last year, it has increased dramatically. So people prefer gold. Maybe it's also the BRICS. They are buying gold, but what's exactly behind the gold rally? And the answer is this. This is the wrong question to ask. If you are asking this type of questions, you will get in trouble in the markets. The right question to ask is, do I have a strategy to capture these moves? This is the right question. Let's look at the relative performance. Year to date, we see gold again 31.4%, stocks, and breadth has improved with the RSP, the equal weight S&P 500 ETF, up 16%, but not too much different from emerging markets. And we have commodities up slightly, but this DBC is basically crude oil, and crude oil crashed this week like 8% or something. And bonds are down, 20 plus year bonds are down 2.2%, although they broke positive territory in the beginning of the month. They are again down. And let's read this tweet. Very smart tweet by Adam Butler, one of the best quants on Financial X. The early March 2024 breakout in gold at around 2,100 per ounce after an 11-year consolidation has been one of the best macro trades in a long time. And still, despite a 30% run, nobody, aside from systematic trend following, is paying attention. Why? This is very smart to it. Very, very smart. Right to the point. Why they are not paying attention? Because they missed it. Simply, they didn't have a strategy to catch the move. Because narratives, macro narratives, do not catch moves. And back in July 10th, I had a tweet that the gold chart looks very bullish, and I will change my view if it drops below 2,100. And it didn't, just continued forging higher. People are buying gold. They have reasons, but you don't want to ask what's behind gold's rally. This is not a proper question in these markets that are driven by algos and more recently, artificial intelligence is getting into the game. So what's a strategy? For instance, in our weekly signals, we use 6 strategies, and one of them, ETF and NRW, those are in the weekly time frame. Went long gold for the week ending March 8, 2024, with a gain of 29.5%. And of course, trend following futures. This is one of our algos with a surprising performance year to date. I didn't expect it. I expected a very dismal results this year, maybe below 10%, but it's up significantly. I still expect some mean reversion by the end of the year. And futures, this algo trades 23 futures contracts. It's been long gold since weekend since the 5th of March, basically, because it's a daily system, with a gain of 23.2%. And these simple strategies, these are simple strategies. They caught the gold's move, but macro analysis did not. Actually, macro analysis failed in early 2010s with bonds. They failed with inflation expectations. They failed again during the pandemic with inflation expectations. They have so many failures, but still it's this escalation of commitment bias that keeps it alive. And I think in a few years with AI, macro will simply die. No one will be interested in macro. Okay, some more things about gold. Its relative performance with stocks, the S&P 500 total return, I repeat, depends on the look back period. For instance, since 1990, stocks have outperformed spot gold by a tremendous margin, 3,284% versus 581%. But if we go to 2000 and use that as a starting date, gold has outperformed stocks 834% versus 535. And then if we move to 2010, as some amateur back-testing accounts on Financial X do, because they try to avoid the bear market, which their systems cannot handle. Since 2010, again, stocks have outperformed gold by a wide margin, 599% versus 146%. And then if we go back to the start of 2022, that bear market, gold is up 49% versus 29% roughly for stocks. So the allocation to gold, it's not an easy exercise. Allocations are random variables, by the way, and few people tell you that. Most of the articles you read about optimal allocations are fooled by randomness. You never know the optimal allocation ex ante, only in hindsight. So you don't know how to invest in important assets like gold or commodities, alternatives in general, and even bonds. Even bonds, you see what happened in 2022, stocks and bonds went down and 60/40 portfolio crashed. So there is this, as you see, this love and hate relationship between stocks and gold. How much you allocate to love and how much you allocate to hate. It's not an easy question to answer. Probably it's not even a proper question to answer because it's all timing luck. Like the people who bought gold in 2000 after the long 90s uptrend are up, making more than stocks significantly, but it was luck. You never know. These are just unique paths that depend on specific macroeconomic conditions, which are very hard to pinpoint, and you don't know what will happen in the future. But my personal opinion, and I'm not a financial advisor, don't trust me on that, and don't pay attention, don't act as in the disclaimer on anything I say, is that it's good to have physical gold, no paper. No paper. Portfolio, of course, physical gold has issues with storage and security, but and also transportation, but paper gold has other issues, like the certificates may get into trouble at some point. We hope not. So, what's behind gold's rally? The answer is don't ask this question. Ask a better question. Do I have a strategy to catch these moves? Have a nice Sunday, and we'll talk soon with on some other subjects. Bye.